Welcome to the Deep Dive, where we cut through the noise and give you the essential nuggets from the latest earnings calls. Today, we're ripping into BJ's Wholesale Club's Q2 fiscal year 2025 results for the 13 weeks that wrapped up back on August 2nd. Now, this quarter presented a really interesting puzzle, How can a company beat profit expectations, show impressive membership growth, and yet still kind of get punished by the market? We're going to try and unravel that paradox for you today. We'll dive into the numbers, explore what management had to say, and connect the dots on why investors reacted with such, caution, despite some genuinely positive signals.
Exactly. The headline numbers for BJ's are a masterclass in nuance, really, and the market's response. It's a clear signal that it's laser focused on the broader macro environment and those all-important sales trends. We'll unpack why that profitability win wasn't quite enough to sway sentiment and what that tells us about what investors really value right now.
Okay, let's get straight to the raw numbers then for Q2 FY 2025. BJ's delivered an adjusted EPS of $1.14. Now, that's a solid beat, topping the consensus estimates, which were hovering around, $1.09 to $1.10. Mm-hmm. So from a profitability perspective, yeah, that's a clear win.
Definitely a win on the bottom line.
But total revenue came in at $5.38 billion. That actually missed the consensus range of $5.46 to $5.49 billion. Even with a 3.4% year-over-year increase, still a miss.
Right, and that's the first flag for the market right there.
Yeah. Now, comparable club sales were a bit of a mixed bag. Overall, they dipped by 0.3%, but management pointed out that was primarily due to fuel price deflation. And here's the critical part. Merchandise comparable sales, when you strip out the gas, they still showed positive growth of 2.3%, mostly driven by an increase in traffic, they said.
And this divergence, it isn't just, fascinating academically, it really reveals the market's current obsession. Are you growing the top line? The EPS beat absolutely points to strong operational execution, great cost management from BJ's, no question there. But that revenue miss, and especially with those merchandise comparable sales, the ex-gas comps, trailing some of their larger competitors, that immediately raises questions about their top-line momentum and, the broader consumer's willingness to spend, particularly in those more discretionary categories.
Right.
It's just a clear, show me the revenue market right now. And even stellar profit performance, it seems, can't fully mask a softer top line when the macro environment feels so uncertain.
Okay, let's unpack this further then, because there's definitely more to this story than just those headlines.
Yeah.
On the membership front, BJ's hit a really significant milestone this quarter. They reached 8 million members.
Wow.
Yeah, that's an impressive 55% growth just since their IPO 7 years ago. And the membership fee income, MFI they call it, grew a healthy 9% year over year to $123.3 million, partly boosted by that fee increase they put through back in January.
Which was expected, but still good to see it flow through.
Exactly. And get this, higher tier membership penetration reached an all-time high of 41%. That's up 50 basis points, 0.5%, just from last quarter. That really suggests members are seeing genuine value in paying for those premium options.
And then this is truly the bedrock, right? The foundation of the whole warehouse club model. MFI is highly profitable, incredibly stable revenue, crucial for navigating, any economic headwinds. The continued growth in both the sheer number of members and, critically, that higher tier penetration, it just signals the underlying strength of their core value proposition.
Yep.
It's a reliable, recurring income stream. It provides a solid foundation, kind of insulated from the day-to-day ups and downs of merchandise sales. Think of it as, their most loyal customers voting with their wallets saying, yeah, this is worth it.
That makes sense. And digital also continued to shine, apparently. Digitally enabled comparable sales surged a pretty robust 34% year over year.
Yeah.
And just to put that in perspective, when you combine this year's growth with last year's, that's a fantastic 56% 2-year stack.
Which is huge.
Yeah. It means nearly double the digital sales volume over 2 years. So it shows consistent, sustained momentum there. Management noted that more than half of their active members are regularly using the app now. And over 90% of those digital sales are actually fulfilled by the clubs themselves through things like Express Pay and Buy Online, Pick Up in Club, BOPIC.
So it's leveraging their physical footprint, not just pure e-commerce.
Exactly. And in merchandising, their Fresh 2.0 initiative, remember that, it started with produce. Well, it's proving successful. They said it's driving strong unit growth in perishables. And now they're expanding that sort of data-driven approach to meat and seafood categories, seeing some exciting early positive results there too.
What's fascinating here, I think, is how digital adoption and Fresh 2.0 aren't just like isolated wins. They feel like truly integrated strategies. They're designed to create deeper member stickiness, Digital enhances convenience, making it easier for their, quote, best members to engage more often, while Fresh 2.0 boosts trip frequency and the overall spend in those critical grocery categories, which are inherently less discretionary, less optional.
So it feeds itself. Better fresh food, more trips, maybe use the app more.
Precisely. This isn't just about better apples or lettuce, it's a strategic lever. Data consistently shows that members who frequently buy fresh items are significantly more engaged. They visit more often, they spend more overall. So Fresh 2.0 is kind of a subtle but powerful loyalty engine, making the club more indispensable in their members' daily lives.
Okay, but now it wasn't all sunshine and growth, was it? Let's talk about the elephants in the room.
Yeah.
Those general merchandise and services comparable sales, they actually declined by 2.2% this quarter.
Oof. Yeah.
Management directly attributed this to, unseasonably wet and cold weather early in the quarter, especially in their core Northeast and Mid-Atlantic markets. And also broader macro factors. Discretionary categories like recreation, lawn, and garden.
Yeah.
They saw double-digit decline.
Double-digit?
Right. Yeah. So essentially, BJ's is saying, don't blame us, blame the rain. But seriously, how much weight does the market really give to weather as a legitimate sales dampener versus, say, just a broader consumer pullback?
That's always the question, isn't it? It's hard to parse out.
But they were proactive, apparently. They aggressively managed inventory. It was down 2% year over year overall, and actually down 6% per club, even though they're operating 11 more clubs.
Okay, so tighter inventory per location.
Right. And despite these tighter inventory buys, they said in-stock levels, maybe surprisingly, improved significantly.
So better management, maybe better forecasting despite the cuts?
Could be.
If we connect this to the bigger picture, though, that cautious inventory management, particularly for discretionary stuff, and those tariff-impacted categories like, say, holiday decor, that's a clear signal of prudence. When I hear aggressive inventory management, it makes me think back to, 2020, 2021, where retailers got totally stuck with mountains of unsold goods.
Oh, yeah, the bullwhip effect.
Exactly. BJ's is clearly learning from that playbook, or at least trying to avoid it, prioritizing profitability over maybe chasing every last sale in uncertain categories. Management's being proactive, right-sizing orders, even resourcing where they can to mitigate those tariff risks and potential consumer elasticity issues. How much will people really pay?
Right.
Now, this might limit the upside if consumer sentiment suddenly flips and improves rapidly, but it largely protects profitability in what remains a, let's face it, very uncertain economic environment. It's a defensive play, really, to preserve those margins.
Okay, so a defensive posture on inventory. Makes sense. So with these mixed results now in the rearview mirror, what's management telling us about the road ahead? Are they feeling bullish, still cautious? Well, BJ's did raise and narrow its full-year FY 2025 adjusted EPS outlook. It's now $4.20 to $4.35, up from $4.10 to $4.30 previously. So a bump on the bottom line outlook.
Confidence and profitability, then.
Seems like it. However, they maintained their ex-gas comparable club sales guidance, still expecting plus 2.0% to plus 3.5% for the full year.
So holding the line on sales growth expectations.
Yep. And on the growth front, actual physical growth, they plan for approximately 8 new club openings in the near term. And then 25 to 30 over the next 2 fiscal years. That's FY 26 and FY 27, including, interestingly, an anticipated entry into the very competitive Dallas-Fort Worth market early next year.
Okay, DFW. That'll be one to watch.
Right.
But that raised EPS guidance. Despite keeping the top line expectations the same, that implies continued confidence in their ability to manage margins and expenses, right?
Yeah.
Even with potential headwinds. That's a strong signal on their cost control. However, they also kind of warned, didn't they, about potential increased investments in the second half of the year to maintain their value proposition for members.
Right, keeping prices sharp.
Exactly, especially given that ongoing consumer caution and the tariff uncertainty that's still lingering out there. They're basically betting that the whole warehouse club channel's relevance actually increases when times get tougher. They're hoping to capture that trade-down effect as consumers actively seek out better value. It's a strategic long-term bet on their model's resilience in tougher times.
Okay, so knowing all of this,
Yeah.
the EPS beat, the raised guidance, the strong membership, the digital growth.
Yeah.
Why the market reaction? Despite all that, the market reacted quite negatively. Shares fell significantly on the day, high volume too. What gives?
Yeah, it highlights a really clear divergence in perspective, I think. Management expressed confidence, right, in their profitability levers, their long-term strategy, like expanding the network, that highly stable membership model.
All the internal stuff they control.
Exactly. But investors, they focus heavily on that revenue miss and the softer-than-hoped ex-gas comps, especially when maybe those numbers didn't quite stack up against some of the larger warehouse club competitors in the same period.
So relative performance matters.
Hugely. The perceived fuel drag on the total comps didn't help either, and just the general sense of consumer stress on discretionary spending.
Yeah.
Those were significant concerns, and apparently those concerns largely outweighed the strong MFI numbers and that robust digital growth. It just pushed the overall sentiment firmly into cautious territory. It reflects that ongoing uncertainty, around tariffs, the potential for inflation maybe accelerating again, and just how consumer spending patterns will shape up into the second half of this fiscal year. Lots of wait and see.
All right, makes sense. Let's switch gears a bit and play a game of what if for our This Is Not Financial Advice segment. Given the cautious market sentiment around BJ's top line, but acknowledging that underlying strength in membership and their proactive management of inventory and sourcing, especially for general merchandise, I'm thinking about an outrageous but plausible trade idea here.
Okay, intriguing. Let's hear it. What's your pitch?
My pitch is long BJ's, short a pure-play discretionary home goods retailer.
Okay. Long BJ's, short home goods. Explain the thinking.
Right. So here's the setup. BJ's has demonstrated, I think, a pretty resilient membership-led model. It inherently benefits from those trade-down behaviors during cautious consumer cycles like we just talked about. Their membership fee income provides that stable, high-margin revenue stream. And they're actively managing tariff impacts on GM through strategic sourcing, cautious inventory buys. They're being smart about it.
Playing defense well.
Exactly. And while GM was weak overall this quarter, remember, apparel actually showed low single-digit growth. That kind of proves that targeted transformation efforts can work within their model. They're investing in value for the long term. Now, on the flip side, you take a pure-play discretionary home goods retailer, heavily exposed to imported goods, totally reliant on, unprompted consumer spending for non-essentials.
Much more vulnerable to sentiment shifts.
Way more vulnerable. They're likely to face sustained pressure, I think, both from tariff-driven cost increases and reduced consumer demand for stuff people just don't need right now. That could lead to higher markdown risk, weaker margins, especially compared to BJ's more prudent inventory management we discussed.
Yeah, they might have to discount heavily just to move product.
Could be. So the market punished BJ's for some GM weakness, sure, but I'd argue BJ's core model provides far, far more insulation than a specialist retailer who's all in on highly discretionary categories. It's really a bet on relative resilience in a tough spot.
That's a compelling argument for relative strength in a challenging environment. It really underscores how different business models respond to the same macro pressures, and how a diversified value proposition like BJ's has with groceries, gas, and GM, plus the membership fee, how that can provide some unexpected buffers. It's a smart way to think about how risk is being priced, or maybe mispriced, in different retail segments right now.
So that's our look at BJ's Wholesale Club's Q2 FY 2025 earnings. A quarter of, solid earnings and pretty good strategic execution, but one where the market's intense focus on those top-line challenges led to a cautious reaction. We really encourage you to consider how these insights shape your own understanding of the retail landscape and the ever-evolving consumer.
Indeed. The story of this quarter is, I think, a powerful reminder that even strong operational performance can be viewed through a cautious lens when those macro headwinds are looming large. The resilience of that membership model and their proactive management of external pressures, those will be key themes to keep watching for BJ's. And maybe as you consider these dynamics, you think about what it truly means for a retailer to control what they can control in an unpredictable market like this, and what long-term value that discipline might unlock down the road.
Good thought. And remember, everyone, the views expressed in our This Is Not Financial Advice segment are strictly for illustrative purposes only. They should definitely not be taken as actual financial advice. Always do your own research and consult with a qualified professional before making any investment decisions. Thank you for tuning into The Deep Dive. We hope this exploration into BJ's earnings provided you with some valuable insights. If you have further questions or topics you'd like us to explore, please do let us know. We'll be back next time with another essential earnings breakdown.